You've probably seen their iconic planes soaring through the sky. Maybe you've even spent a few hours in one of their terminals during a layover. I'm talking, of course, about American Airlines. You recognize the brand, you definitely know the name. But how well do you really know the company behind those wings?
Yeah, that's the key question, isn't it?
Today, we're pulling back the curtain, taking a really comprehensive deep dive into American Airlines Group, Inc. The ticker symbol is AAL.
That's right. And our mission today, well, it's to give you a thorough, really objective understanding of this airline giant. We're going to unpack the financial data, operational insights, and, the broader market context that shapes AAL's position in what is, let's face it, a fiercely competitive aviation landscape.
Absolutely fierce.
And we've compiled a pretty robust stack of sources for this deep dive. We've got detailed stock performance data, some fascinating insider trading reports, the latest corporate earnings transcripts, and even their extensive corporate lobbying records and innovation patents.
Wow, okay. So buckle up, because you can expect us to distill the most important nuggets of knowledge from all these documents. We'll highlight some truly surprising facts, things you might not have known about one of the world's largest airlines. And we'll help you connect the dots so you can walk away truly well-informed about AAL. Our aim here is really to provide an objective financial analysis, giving you the facts and the context without, any bias or baseless praise.
Exactly. Just the data, the context, what it means.
Let's take flight.
Let's do it.
All right, so let's start with that high-level view of American Airlines. What exactly are we looking at here beyond just, the planes we see buzzing around?
Well, at its core, American Airlines Group, Inc. isn't simply an airline. It's actually structured as a holding company.
Okay.
It operates primarily through its wholly owned mainline subsidiary, which most people just know as American. Their fundamental business, as you'd guess, is air transportation. They serve both passengers and cargo needs, and they do it globally. This isn't just some regional player. They're an enormous enterprise.
Okay.
And they operate strategically across distinct geographical segments: domestic, Latin America, Atlantic, and Pacific. Each of those segments is really a critical pillar of their global network and, importantly, their revenue streams.
And when you say enormous, you're definitely not exaggerating, are you? My sources show they're a true market leader, like on a global scale.
Absolutely not exaggerating. American Airlines stands as the world's largest airline. And that's not just, a casual claim.
Right.
It's backed up by three critical metrics that really define airline scale. First, the sheer number of aircraft in their massive fleet.
Okay.
Second, their overall capacity across all the routes they operate, that's measured in something called available seat miles. And third, the total scheduled revenue passenger miles they fly, which basically indicates their volume of paying passengers. This trio of metrics, it paints a picture of a truly colossal operational footprint. They dwarf many other carriers out there.
That's incredible scale.
Yeah.
And it's enabled by some key strategic hubs here in the U.S., right? Those are absolutely vital for that global reach you mentioned.
They are, yeah. Their major U.S. hubs are strategically spread out across key metropolitan areas. They really form the backbone of their domestic and international network.
Like where?
We're talking about bustling airports in Charlotte, Chicago, Dallas-Fort Worth, that's a huge one, Los Angeles, Miami, New York, Philadelphia, Phoenix, and Washington, D.C.
Okay.
These hubs are just crucial for connecting passengers and cargo efficiently across their vast network. They're like the central nervous systems for their operations.
Makes sense.
And what's particularly fascinating here, maybe a bit surprising to some, is American Airlines' significant strategic focus on Latin America.
Oh, really? How so?
Well, our sources indicate that more than 30%, over a third of their U.S. airline revenue, actually comes from connecting Latin American destinations with the United States.
Wow, 30%. That's huge.
It really is. This isn't just some side business. It's a massive, deeply integrated segment of their revenue pie. It highlights a core strength and, frankly, a differentiated market position compared to some competitors who might focus more heavily on, say, transatlantic or transpacific routes.
Oh.
This strong historical presence and network in Latin America gives them a real competitive advantage in a region with, growing travel demand.
Okay, 30% from Latin America. That truly is a major piece of their revenue. And I also noted something about their fleet. You mentioned it earlier.
Yeah.
Youngest among U.S. legacy carriers. That's not just like a bragging right for an airline, is it? It must have profound operational and financial benefits.
Oh, absolutely. It's a direct result of a multi-year, multi-billion-dollar fleet renewal effort they've undertaken. It's a big deal.
How so? What are the benefits?
Well, a younger fleet translates into several significant operational advantages that directly impact the bottom line. For one, you're looking at vastly improved fuel efficiency.
Okay, that's key.
It is. In an industry where fuel is often the largest single operating expense, even a slight improvement in mileage per plane can result in massive cost savings.
Right.
Secondly, newer aircraft typically require less frequent and less costly maintenance.
Reliability.
Exactly. This leads to better operational reliability, fewer unexpected delays, and ultimately, a more positive and predictable experience for passengers.
Which probably helps with customer loyalty, too.
For sure. That fosters customer loyalty and contributes to revenue stability. It's an investment that pays off in multiple ways, from reduced operating expenses to an enhanced brand reputation.
So it's a strategic investment. Definitely impacts both their cost structure and customer satisfaction. Okay, and for those curious about the company's origins, American Airlines Group, Inc. was founded on December 9, 2013. Its IPO date aligns with that founding. It's headquartered down in Fort Worth, Texas, which is a pretty central location. Makes sense for supporting its extensive domestic network.
Right.
And in terms of sheer human capital, they employ a tremendous number of people. My FinViz data shows 133,300 employees. Though another source, Quiver, has it slightly higher at 138,100.
Yeah, that slight variation is pretty normal in dynamic data sets like this. It often reflects different reporting times or, data collection methods, just as you said.
Right, timing differences.
But the core insight remains, American Airlines is a significant employer. They underpin the livelihoods of well over 100,000 individuals.
Yeah.
It just underscores the immense scale of their operations and their substantial economic footprint, not just as a transportation provider, but as a major employer in tons of communities.
Okay, that gives us a solid overview of their identity and scale.
Yeah.
So what does this all mean for their current market standing, especially as of August 13th? That's the snapshot date for our sources.
Right. As of August 13th, the stock closed at $13.11. It marked a modest daily increase, about $0.13, or 1.00%. But to truly understand its market valuation, especially for a company this big, we need to look beyond just the stock price. We use two key figures: market capitalization and enterprise value.
Right, market cap first.
Their market cap stands at $8.65 billion. Now, this figure represents the total value of all its outstanding shares. It's essentially what the public market believes the company is worth based on its stock price. It's what you'd pay if you wanted to buy all the company's shares on the open market.
Okay, $8.65 billion. But then there's this other figure, enterprise value, which is way larger, a substantial $36.47 billion. Why such a huge difference? And why is enterprise value so critical in an industry like airlines? It seems like it tells a much fuller story.
That's a crucial distinction, absolutely, and understanding it is paramount if you're analyzing capital-intensive industries like airlines.
Right.
While market capitalization only accounts for the equity portion, what shareholders own, enterprise value, or EV, gives you a much more complete picture of a company's true total value.
How does it do that?
It includes market capitalization, sure, but it also adds in the company's total debt and subtracts its cash and cash equivalents.
The debt.
Exactly. For airlines, which typically carry substantial amounts of debt to finance those enormous aircraft acquisitions, infrastructure, ongoing operations, enterprise value provides a far more accurate and comprehensive valuation metric. It captures the total cost of acquiring the entire business, including its liabilities.
So it's better for comparing companies.
Yes. It allows for a more apples-to-apples comparison between companies with different capital structures, especially in sectors where debt plays such a dominant role in financing growth and operations.
Gotcha.
The fact that American Airlines enterprise value is more than 4 times its market cap just underscores the significant debt load it carries. And that's a common characteristic across the airline industry, but it's really important to keep in mind.
All right, now that we have the bird's eye view, let's truly decode the financials. This is where the numbers really start to tell a crucial story about American Airlines and, what investors are actually paying for. Starting with valuation metrics, what can we tell from these numbers about how the market perceives AAL's worth?
Absolutely. The valuation metrics give you a snapshot of how the market is pricing American Airlines, given its earnings, its sales, its assets. Let's start with the price to earnings, or PE ratio. It's currently 16.86.
Okay, 16.86. What does that mean practically?
Think of it like this. For every dollar American Airlines earns right now, the market is willing to pay about $16.86. Now, on its own, that number doesn't tell the whole story,
Right.
but it's a crucial starting point for comparing it to competitors or even its own historical performance. Generally, a higher PE might suggest investors expect higher future growth, or maybe that the stock is relatively expensive.
And then there's the forward PE, which is significantly lower at 7.97. What does that spread between the current PE and the forward one tell us about investor expectations?
Yeah, the substantially lower forward PE is quite telling. It's based on expected future earnings.
Okay.
And when it's much lower than the current PE, it generally suggests a strong belief in recovery or growth. Investors are anticipating significantly higher earnings in the coming year.
So potential undervaluation based on the future.
It could mean the stock is currently undervalued based on those future projections, exactly. It's a forward-looking sentiment that indicates some optimism about their near-term profitability turnaround.
That makes sense. But then we see the PEG ratio, which relates PE to earnings growth, standing at 3.02.
Yeah.
Now, I typically hear that a PEG ratio below 1.0 is considered favorable. So what does a 3.02 signify for AAL, especially considering that hopeful forward PE?
You're astute to point that out. That's a really good question. The PEG ratio tries to balance the PE with the company's earnings growth rate.
Right.
A PEG below 1.0 is generally seen as indicating a stock that might be undervalued relative to its growth potential. Suggests you're getting growth on the cheap, so to speak.
But 3.02 isn't cheap.
No. A PEG of 3.02, on the other hand, suggests that even with those projected higher earnings, the stock might be considered quite expensive relative to its expected future earnings growth rate.
So the price might be getting ahead of the growth.
It implies that the current price might be outstripping the anticipated pace of earnings expansion. Suggests the market is already pricing in a lot of that expected future growth.
Okay.
This can make some investors cautious, right? Because it means there might be less room for upside if growth doesn't meet those very high expectations.
Okay, so a nuanced signal there. How about the price to sales, or PS ratio? It's at a remarkably low 0.16. That seems exceptionally low, almost like the market isn't giving them much credit for their revenue at all.
It is indeed exceptionally low. A PS ratio of 0.16 means the market values American Airlines at only 16 cents for every dollar of sales it generates.
Which could mean it's undervalued.
It certainly can suggest significant undervaluation, especially if you look purely at the top-line revenue generation. However, for an industry like airlines, it can also reflect the inherent challenge of achieving high profit margins.
The thin margins.
Exactly. Airlines operate on notoriously thin margins. They have immense fixed costs, fuel price volatility is a killer, and the competition is just intense. So even high revenue doesn't always translate into substantial profit that would justify a higher PS multiple.
Right.
It highlights that generating revenue is one thing, but converting it into profit is another much more challenging battle in this sector.
Which brings us to a major point, one that often raises red flags in traditional financial analysis. The price-to-book ratio is listed as just a dash. And the book value per share is actually negative at negative $5.87. That means the company's liabilities exceed its assets. How do we, as informed listeners, make sense of such a significant indicator, especially for an airline?
This is a critical point, and it requires careful, nuanced discussion, especially in the context of the airline industry and, the period following massive disruptions like the pandemic. A negative book value per share and for the price-to-book ratio mean exactly what you said. The company's total liabilities, including substantial debt, outweigh its total assets on the balance sheet.
Which sounds really bad.
In a purely traditional sense, for most businesses, this would indeed be a severe red flag. It could indicate deep financial distress, maybe even long-term insolvency risk if it persists.
But it's different for airlines.
Well, it's not entirely uncommon for airlines, particularly after periods of heavy investment in new aircraft or industry downturns or global crises like COVID-19, which required massive borrowing just to survive.
Right. They had to borrow huge amounts.
Exactly. Airlines are incredibly capital intensive. They buy planes that cost hundreds of millions of dollars, often financing them with debt. The pandemic forced airlines to take on unprecedented levels of debt just to stay operational. Many also faced asset write-downs.
So what does it really signify for AAL?
It signifies a highly leveraged balance sheet. Debt has been used extensively to finance their operations and that big fleet modernization we talked about. While it absolutely highlights financial risk and challenges in rebuilding shareholder equity, it doesn't necessarily mean imminent collapse.
So what should we focus on instead?
The key insight for you as an investor or observer is to look beyond this static book value and focus intently on their cash flow generation and debt management.
Cash flow.
Can they pay their bills? Can they service their debt? Can they invest for the future, even with this heavily leveraged balance sheet? That's the real question. It pushes us to examine other metrics that assess their ability to generate cash rather than just their accounting book value.
Fascinating. So it's a red flag, but one that needs that industry-specific context. What about price to cash and price to free cash flow? How do these metrics complement our understanding given that negative book value?
These are often more relevant for capital-intensive businesses like airlines. The price-to-cash PC ratio is 0.92. That looks at the price relative to the operating cash flow per share.
Less than 1.
And the price-to-free cash flow PFCF ratio is 5.53. These are generally healthier signs, especially the PFCF.
Why is free cash flow so important here?
Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets, like buying new planes or fixing old ones. If a company can consistently generate positive free cash flow, it indicates an ability to fund its operations, potentially pay down that significant debt we discussed, or invest in growth initiatives without relying solely on external financing.
So it's a sign of financial health.
It's a strong indicator of financial health and operational efficiency, especially for airlines that need to continuously reinvest in their fleet. Much more useful than book value in this case.
And finally, for valuation, EV/EBITDA at 7.67 and EV sales at 0.67. Why are these enterprise value-based ratios particularly important for an airline? Maybe even more so than the traditional PE or PB.
Right. These enterprise value-based ratios are incredibly important for capital-intensive sectors for precisely the reasons we discussed about debt. They provide a much more holistic valuation metric than PE alone because they account for the entire capital structure, including that substantial debt load. Okay.
EV/EBITDA at 7.67 helps compare companies on an operating basis, neutralizing the effects of different debt levels and depreciation policies. It's a cleaner measure of operating performance relative to the total value of the company.
And EV sales.
EV sales at 0.67 does something similar but against revenue. Gives another comprehensive look at how the entire capital structure is valued against sales. They are often considered superior for comparing airlines because they factor in the significant debt these companies typically carry, allowing for a more accurate peer comparison across the industry.
Okay, so that's what investors are paying for. Now let's talk about profitability and efficiency. How well is American Airlines managing its extensive operations to actually convert all that revenue into profit? Let's dive into their earnings per share or EPS.
Right, the earnings per share figures, they paint a very dynamic and, honestly, at times, contrasting picture. Their TTM EPS, meaning trailing 12 months, is $0.78.
Okay, positive.
However, looking forward, EPS for next year is projected to be $1.64.
Whoa, more than double. Yeah, this projected surge in EPS aligns directly with the lower forward PE we just discussed. It strongly suggests expectations of a robust earnings recovery. Indicates that analysts and the market believe the company is on a path to significantly improve its bottom line in the coming fiscal year.
But here's where it gets really interesting, maybe confusing. Creating a significant tension for anyone looking at AAL. EPS for the next quarter is projected at negative $0.28, indicating an expected loss. This seems to directly contradict the CFO's sentiment reported in the news that the worst is over. How do we reconcile that conflicting outlook? It's confusing.
That is precisely the paradox you, the listener, need to grapple with when evaluating American Airlines. It's a great point. On one hand, you have the CFO expressing confidence that the worst is over, likely referring to broader post-pandemic recovery trends, underlying demand stability, maybe long-term cost management initiatives. It's a strategic, big-picture statement of optimism. On the other hand, the specific quarterly forecast signals a near-term dip into unprofitability. This could be due to a number of factors common in the airline industry.
Like what?
Perhaps seasonal softness, typical for that quarter, anticipated fluctuations in fuel costs, which can quickly erode margins, or even just the timing of specific operational expenses like maintenance cycles or employee training that fall disproportionately into that period.
Right, the timing matters.
It highlights the inherent volatility in those razor-thin margins in the airline industry. A single quarter can easily swing into a loss despite broader positive trends or executive optimism.
Okay.
It's a crucial point for you to consider because it shows the complexity of predicting airline performance. The long-term trajectory might be looking up, but the short-term path can still have significant bumps.
And the year-over-year growth figures are just as wild. They show the dramatic recovery path. EPS this year is down 76.52%, but EPS next year is projected to grow a massive 257.35%. That's a dramatic swing, but what does it really tell us? Is it real growth?
It is indeed dramatic, and it needs careful context. The severe negative growth this year likely reflects lingering impacts from the pandemic's disruptions and subsequent recovery challenges, or maybe comparisons to unusually strong, perhaps one-off quarters in the past. The massive projected growth for next year, while impressive on paper, often signifies a strong recovery from a very low base.
The base effect.
Exactly. It's not necessarily indicative of sustainable astronomical growth rates year after year, but rather a rebound towards more normalized profitability after a really challenging period.
And the longer view.
Looking at the longer term, our sources show past 3 to 5 year EPS growth is still negative at negative 20.93%.
Wow.
That indicates a pattern of earnings contraction over a longer historical period before this recent rebound. Emphasizes that while the recent recovery is strong, the company has faced significant multi-year profitability challenges.
So long-term earnings contraction, but a powerful recent rebound from a low point.
Yeah.
What about the very recent quarterly performance?
Well, EPS year-over-year TTM is 556.18%. Again, showing a strong recent improvement, almost certainly from a very low comparative base from the depths of the pandemic's impact.
Right.
However, the EPS quarter-over-quarter is down 8.87%. That indicates a recent quarterly decline, which directly reinforces that projected loss for the next quarter we just discussed.
Okay, so consistency is an issue.
But what's intriguing is their EPS surprise. American Airlines exceeded EPS expectations by 21.78% in the last reported quarter, and sales by 0.68%.
So they beat expectations.
Yes, which suggests the market might have been overly pessimistic heading into that quarter despite the negative Q3 outlook that followed. It points to a company that can sometimes outperform even subdued market expectations, which can be a positive signal for investor sentiment.
All right, let's switch to sales performance. What does their revenue picture look like across different time frames? Is the top line growing, even if the bottom line is so volatile?
Total sales for the trailing 12 months are substantial, $54.25 billion.
Big number.
It is. When we look at sales growth over the past 3 to 5 years, it's 21.96% and 3.44% respectively. This indicates a healthier, albeit somewhat inconsistent, revenue growth trajectory compared to their EPS over the same periods. Suggests they've largely recovered their pre-pandemic revenue levels and are showing some expansion.
And more recently?
More recently, sales year-over-year TTM is 1.50%, and sales quarter-over-quarter is 0.40%. This suggests steady, if relatively slow, recent growth in revenue, which is, a foundational requirement for any profit recovery. You need the sales first.
True. And what about those all-important profit margins? What do they tell us about how much of that massive $54 billion in revenue actually trickles down to profit after all the costs of running an airline?
Profit margins. This is where the true operational efficiency and the inherent challenges of the airline industry are most starkly revealed. Their gross margin is 20.75%.
Okay.
That's the profit left after covering the direct costs of providing their services, think fuel, crew salaries, that kind of thing. The operating margin is 5.06%. That represents profit after operating expenses like salaries, marketing, administration are factored in.
Okay, 5%.
Finally, the profit margin, which is the ultimate percentage of revenue that becomes net profit after all expenses, including interest and taxes. It's a very thin 1.05%.
Wow, just over 1%.
These relatively thin margins are highly characteristic of the airline industry. It's a high-volume, capital-intensive business with significant fixed costs, aircraft leases or depreciation, maintenance, labor.
Right.
Even small fluctuations in fuel prices, labor costs, or economic downturns can just quickly erode these already slim margins. It highlights the tightrope they walk. They need to fill planes, manage costs meticulously, and extract every possible dollar from ancillary services just to maintain even a modest profit.
That certainly highlights the incredible challenge. And then we have return on assets, ROA, at 0.89%, and return on invested capital, ROIC, at 2.05%. What do these figures signify about how efficiently they're using their vast assets and capital to generate profits? Seems low.
They are quite low. These ratios measure how effectively a company is using its assets and the capital invested in it to generate profits. An ROA of 0.89% shows that American Airlines generates less than a penny of profit for every dollar of assets it holds.
Okay.
Similarly, ROIC at 2.05% indicates that for every dollar of capital invested, both debt and equity, they're generating just over 2 cents in profit.
Not great returns.
No. And they reflect the intensely capital-intensive nature of the airline industry, where enormous investments are required for aircraft and infrastructure. Coupled with the competitive pressures that compress profit potential, it means they have to work incredibly hard just to squeeze out returns on their significant asset base. For you, the listener, these numbers underscore the immense scale of investment required in this industry and the sheer difficulty of earning robust returns on that capital.
And similar to the price to book, the return on equity, ROE, is listed as just a dash again. This again points back to that negative equity we discussed earlier.
Right. Precisely. The negative shareholder equity liabilities exceeding assets renders a traditional ROE calculation impossible or meaningless.
Right.
It reinforces the point about their highly leveraged balance sheet and the challenges they face in rebuilding their equity base. It's a direct consequence of the financial strains they've faced, particularly post-pandemic, where debt accumulation just outpaced asset growth and earnings. So while ROE is a critical measure for many companies, for American Airlines right now, other metrics like cash flow and those enterprise value ratios offer a more practical understanding of their financial standing.
So significant debt and negative equity are definitely recurring themes, signaling ongoing financial challenges. That brings us naturally to liquidity and solvency. Can American Airlines actually meet its obligations, especially in the short term, given that high debt load?
Yeah, this is a crucial area for any company, particularly one with a challenging balance sheet. They do have a positive sign in their cash per share, which is $14.22.
Okay, that sounds good relative to the share price.
It does. It indicates a substantial amount of cash relative to the share price, offering some operational flexibility and a buffer.
Right.
However, when we look at their current ratio, it's 0.58.
Below 1.
Right. This ratio assesses short-term liquidity. A value below 1.0 means that current liabilities exceed current assets. Think of it like this. For every dollar of bills American Airlines needs to pay in the next year, they only have about 58 cents readily available in cash or assets that can quickly be turned into cash.
And the quick ratio is even lower at 0.48, which sounds even more concerning.
Yes, the quick ratio is a more stringent measure of liquidity because it excludes inventory, which isn't really a major liquid asset for an airline anyway, not like for a retailer.
Right.
Both ratios suggest a tight short-term liquidity position. Now, while airlines often operate with lower current ratios due to their predictable revenue streams and large fixed assets, these figures certainly indicate a need for careful, active cash management.
So they're walking that tightrope.
Constantly. They need to ensure a continuous flow of revenue to cover their short-term obligations. This is why factors like strong ticket sales and efficient operations are just so paramount for them.
And circling back to debt, their debt to equity, DE, and long-term debt to equity, LTDE, are both listed as, again, because of the negative shareholder equity. But it's important to clarify, this doesn't mean they have no debt, does it? Quite the opposite.
Yes, exactly. This reinforces that negative book value again. It doesn't mean they have no debt. Quite the opposite. It means their debt is extremely significant relative to their equity. It effectively shows that the company's capital structure is heavily reliant on borrowed funds rather than shareholder investment.
Which is common for airlines, but risky.
Very common, but it highlights a higher level of financial risk, absolutely. A sustained downturn in revenue, a spike in fuel prices, an increase in interest rates, any of those could quickly put severe pressure on their ability to service that debt. For you, the listener, it emphasizes that understanding their debt obligations is critical to assessing their long-term viability.
And finally, on the dividend front, my sources indicate no estimated dividend, no TTM dividend, no payout ratio. The last dividend ex-date was February 4, 2020. That clearly points to the profound impact of the pandemic, doesn't it?
It does, crystal clear. The complete absence of dividends since early 2020 directly correlates with the severe financial impact the COVID-19 pandemic had on the entire airline industry.
Right.
Companies in the sector universally suspended dividends. They had to conserve vital cash, manage their ballooning debt loads, and simply navigate the unprecedented collapse in travel demand.
Survival mode.
Totally. It signals a strategic prioritization of financial stability and operational resilience over shareholder payouts during exceptionally challenging times. It's a reminder that while the airline industry is recovering, many companies are still in a phase of financial deleveraging and rebuilding. Shareholder returns via dividends often take a back seat in that environment.
Okay, we've thoroughly dissected the financials, and it paints a picture of a company navigating some pretty significant challenges. Now let's turn our attention to how the market actually feels about American Airlines. What does the stock performance and volatility tell us about investor confidence, or lack thereof?
Right. This is where we see the market's reaction to all those financial numbers and the broader industry dynamics. And American Airlines has seen some notable positive short-term movements recently.
Like what?
Over the past week, the stock is up 11.67%. Over the past month, it's up 7.72%. And over the past quarter, it's up 6.59%.
Okay. Decent short-term pops.
These are significant positive moves, suggesting a recent rally and maybe some favorable market reactions, perhaps indicating that investors are looking past the immediate challenges and focusing more on the recovery narrative.
That's a good bounce. Certainly welcome news for recent investors. But the picture shifts quite a bit when we zoom out to the longer term, doesn't it?
Indeed. The performance over the longer term reveals a far more mixed and, at times, pretty challenging story. Year to date, the stock is down 24.78%. Ouch. And over the half year, it's down 20.11%. This suggests that while there have been recent positive movements, they are primarily recovering from a significant downturn earlier in the year.
But the full year is positive.
Interestingly, yes. Over a full year, the stock is up 32.96%. This contrast between the year-to-date and one-year performance indicates there was a sharp drop earlier in the trailing 12-month period, followed by this more recent, robust rally that has pushed it into positive territory for the full year.
So it's been a truly turbulent year, to say the least. But then we hit the 10-year mark, and the number's just striking. A staggering negative 69.48%.
Yeah.
What is that long-term decline of nearly 70% in shareholder value over a decade? Tell us about the airline industry and AAL specifically. It seems to suggest a really deep underlying challenge.
That 10-year figure is profoundly striking. It's incredibly important for any long-term perspective. A nearly 70% decline in shareholder value over a decade indicates significant, persistent long-term challenges, not just for American Airlines, but frankly for the airline industry as a whole.
What kind of challenge?
Well, this period has seen intense competition, especially from low-cost carriers. Extreme volatility in fuel prices, numerous labor disputes, and of course the unprecedented demand shock of the COVID-19 pandemic, which essentially brought global travel to a halt.
Right.
It suggests that despite periods of recovery and strategic efforts like fleet modernization, the fundamental business model of legacy airlines has struggled to consistently generate robust long-term value for shareholders.
Why is that?
It often boils down to those thin profit margins we talked about, the highly cyclical nature of travel demand tied to the broader economy, and the immense capital requirements for fleet maintenance and expansion. For you, the listener, this figure serves as a potent reminder of the inherent difficulties and risks associated with long-term investment in this specific sector.
That truly highlights the formidable environment they operate in. Let's look at the price range more closely. The 52-week high was $19.10, and the current price is about 31% down from that. But the 52-week low was $8.50, meaning the current price is up over 54% from that low. So while it's nowhere near its recent peak, it has rebounded significantly from its recent bottom.
Exactly. This implies that while it's nowhere near its peak from the last year, it has demonstrated a strong rebound from its nadir. That indicates some renewed investor confidence or maybe a perception that the worst of the recent downturn is indeed behind it, at least in the short term. It shows some resilience in bouncing back from lower valuations.
And volatility is a very big factor in airlines, isn't it? Our sources show daily volatility at 4.03%, weekly at 3.26%, and the beta is 1.4. What does that beta number specifically tell us about AAL as an investment? Sounds high.
Beta is a crucial measure for investors, yeah. It quantifies a stock's volatility in relation to the overall market. A beta of 1.40 means that American Airlines stock is theoretically 40% more volatile than the broader market.
So in bigger swings.
In practical terms, yeah. When the market moves up by, say, 1%, AAL stock tends to move up by 1.4%. Conversely, when the market falls by 1%, AAL tends to fall by 1.4%.
Right.
This makes it higher risk investment, prone to larger swings both up and down, which is highly characteristic of the cyclical and event-sensitive airline industry.
And that ATR.
The ATR, average true range at 0.47, also gives you a tangible sense of its daily price swings. It means that, on average, the stock's price moves by about 47 cents each day. That's a notable swing for a stock trading in the mid-teens. This daily volatility is something you definitely need to be comfortable with if you're thinking about AAL in your portfolio.
And the RSI, Relative Strength Index, is 66.98. What does that suggest about recent buying momentum? Should investors be cautious?
The RSI is a momentum oscillator, often used to identify overbought or oversold conditions. An RSI over 70 is generally considered overbought, suggesting the stock might be due for a pullback because it has risen too quickly.
And AAL is close to 70.
At 66.98, yeah, American Airlines is nearing that territory. It suggests strong recent buying momentum, but it also cautions that the stock might be getting a bit ahead of itself in the very short term. It implies that while there's strong interest, maybe a period of consolidation or a minor correction wouldn't be unexpected.
And the moving averages confirm that recent strength.
They do. Looking at the moving averages, the SMA 20 is up 10.11% and the SMA 50 is up 12.81%. That shows strong short to medium term uptrends, reinforcing the recent positive momentum. However, the SMA 200 is still slightly negative, down 1.15%, which reflects that longer-term struggle we identified earlier with the 10-year performance.
Okay, let's talk about analyst sentiment. What's the current consensus, and how has it been shifting? It seems like quite a roller coaster based on the data.
It absolutely is a roller coaster. The overall analyst recommendation for AAL is 2.17. Now remember, 1.0 is a strong buy and 5.0 is a strong sell.
So 2.17 is
hold. Pretty much. It places it squarely in the hold or neutral range, indicates that analysts are not overwhelmingly bullish or bearish right now.
the price target.
The average target price is $13.46, which is just slightly above its current price of $13.11. That suggests limited immediate upside according to the consensus of analysts.
But the more interesting story, as you mentioned, is the sharp fluctuation in individual analyst ratings. I'm seeing some very recent downgrades, but also a flurry of upgrades in the preceding period.
Yeah.
It's a dynamic that speaks volumes about the industry's sensitivity, doesn't it?
It perfectly illustrates the volatility and sensitivity of the airline industry to changing economic conditions and company performance. Let's trace it chronologically. It's kind of fascinating.
Okay.
We've seen recent downgrades in April 2025. Major firms like Goldman Sachs moved to a sell rating, Jefferies moved to a hold. This suggests a more cautious outlook from some significant players, perhaps reacting to specific news or broader market conditions impacting the sector.
But before that?
Right. Prior to that, from roughly January to December 2024, there was a whole flurry of upgrades to buy or outperform. Multiple prominent firms, Redburn Atlantic, BofA Securities, TD Cowen, Milius, Jefferies again, Raymond James, Bernstein, Seaport Research Partners. It was a wave of optimism back then.
And then the roller coaster continues. In July 2024, Bernstein and TD Cowen downgraded it again, only for TD Cowen to upgrade it back to buy in January 2025, after reiterating hold multiple times throughout the year. That dynamic is just wild, demonstrates the rapid shifts in outlook.
It's a perfect case study in how quickly sentiment can pivot in this sector. Analyst sentiment isn't static, it's highly reactive.
To what?
To the latest earnings reports, fluctuations in fuel prices, broader macroeconomic trends, geopolitical events, even competitor performance. A simple buy or sell recommendation for an airline stock is rarely straightforward because the underlying fundamentals can shift so rapidly.
Yeah.
These sharp swings just highlight the complexity of forecasting in this sector and how quickly consensus can change. It makes it a challenging environment for investors relying solely on analyst ratings.
And those analyst actions can have a very real and immediate impact on the stock price and broader investor perception, can't they?
Mm-hmm.
The downgrade can really hurt.
They certainly can. A downgrade from a major firm can trigger a significant sell-off, as institutional investors and funds might adjust their positions based on these recommendations, especially those with mandates tied to analyst ratings.
And upgrades.
Conversely, a flurry of upgrades can signal a bullish shift and attract new capital, driving the price up. It creates a powerful feedback loop in the market, influencing both short-term trading patterns and broader investor sentiment. Underscores the importance of understanding the reasons behind these rating changes, not just the ratings themselves.
Now, let's look at who actually owns American Airlines stock and what kind of trading activity we're seeing from key groups. What about insider ownership? How much do company executives and board members hold? Is it significant?
Insider ownership is relatively low, actually. It's at 1.53%.
Okay, not much skin in the game from insiders.
Well, it means that company executives and board members, while having a vested interest, hold a comparatively small portion of the total outstanding shares. In contrast, institutional ownership is quite significant, standing at 64.63%.
So mostly big funds own it.
Exactly. This indicates that large institutions like mutual funds, pension funds, hedge funds hold the vast majority of American Airlines stock. They are the major players in this investment, and their buying and selling activity can significantly influence the stock's direction.
And are these large institutions, on balance, buying or selling American Airlines stock recently?
Recent institutional transactions show a slight net selling of meggish 1.50%. That indicates that institutions, on balance, have been shedding a small portion of their holdings recently.
Why might that be?
Could reflect portfolio rebalancing, maybe some profit-taking after the recent run-up, or perhaps a cautious stance given some of the mixed signals we've discussed, like that Q3 outlook.
And what about short interest? Are a lot of investors betting against American Airlines, hoping its stock price will fall?
There's a notable portion of investors betting against the stock, yeah. Short interest is at 9.61% of the float. That amounts to 62.46 million shares short.
So, significant bearish bets.
It indicates a significant number of bearish positions. However, the short ratio, which measures how many days it would take for short sellers to cover their positions based on average trading volume, is 1.01.
What does that tell us? Is a short squeeze likely?
That ratio suggests relatively low pressure in the short selling market right now. If the ratio were significantly higher, it would imply that a short squeeze, where short sellers rush to buy back stock to cover their positions, driving prices up rapidly, could be more likely. At 1.01, it suggests a more manageable short-term dynamic for the short sellers. Not a lot of immediate pressure to cover.
Let's move to specific insider trading activity. I see some notable sales from high-level executives in the data. What can we infer from these? Should we be worried?
Yes, our sources show some recent insider sales from top executives. Angela Owens, the senior vice president and corporate controller, she had a sale of about 51,900 shares for roughly $890,000 on January 27, 2025.
Okay.
And Robert D. Isom Jr., the CEO and president, he sold about 102,400 shares for approximately $1.76 million on December 27, 2024.
So big sales from the top.
Yeah. They are notable sales. But it's important for you, the listener, to understand that insider sales don't always signal a lack of confidence in the company's future.
Why else would they sell?
Executives often sell shares for a variety of personal financial planning reasons. Maybe diversification of their personal portfolios, buying a house, tax planning related to exercising stock options, lots of reasons.
Okay.
However, it is noteworthy that the provided data does not show any significant purchases by insiders in the same period. Insider buying would otherwise balance out these sales and indicate a stronger vote of confidence in the stock at its current levels.
So, sales without buys. Something to note.
It's a piece of the puzzle, but not the whole picture. Definitely something to be aware of.
And perhaps one of the most intriguing insights from our sources, offering a unique glimpse into market participation, is the activity we see from members of Congress. There are multiple Congress members, both Republican and Democrat, engaging in trades of AAL stock.
That's right. The data reveals various reported trades by U.S. Congress members. It's quite interesting to see.
Like who?
For example, Tim Moore, a Republican House member, he's had a mix of sales and purchases of AAL stock between March and June 2025. Amounts ranging from $15,000 up to $500,000.
Wow.
Ro Khanna, a Democratic House member, also shows both sales and purchases, though in smaller amounts, typically in the $1,000 to $15,000 range between 2022 and 2024. Pat Fallon, another Republican House member, shows a series of sales and purchases going back to 2021. We also see purchases from Republican House members Mark E. Green and Michael K. Simpson back in March 2021, and a sale from Democratic House member Dean Phillips in January 2021.
So activity on both sides of the aisle.
Yes. And it is crucial to understand, for you listening, that these are simply recorded factual trades. They're part of publicly available financial disclosures for members of Congress.
Right, just reporting the data.
Exactly.
Yeah.
This segment is not intended to imply any endorsement of the stock, nor any political bias for or against any party. We're merely reporting the documented activity as part of a comprehensive view of who is trading American Airlines stock. For you, the listener, this transparency offers a unique, if sometimes provocative, glimpse into how individuals closely tied to policymaking also navigate the market. It just underscores the broad interest in, and sometimes the speculative nature of, investing in a company like American Airlines across various influential groups.
That's certainly a unique angle, seeing the trading activity of Congress members. Okay, now let's move beyond the core financial statements and delve into recent news, operational strategies, American Airlines innovation efforts, and how they wield their influence in Washington. What's been happening in the news recently, especially around their Q2 2025 earnings, seems like there were some tailwinds.
Yeah, recent news around August 2025 has pointed to some positive tailwinds for American Airlines and the broader airline sector. Reports highlighted the company flying higher due to a fortunate combination of lower fuel prices, which is a massive cost relief for airlines.
Huge relief.
And simultaneous airfare jumps, indicating strong pricing power.
So cheaper gas for them, but pricier flights for us.
Essentially, yes. More broadly, airline stocks as a sector have been taking flight post-CPI reading, enjoying these tailwinds. This broad market trend can significantly impact an airline's profitability, even outside their own specific actions.
That sounds like a great setup for a strong earnings report.
Right.
But when we look at their Q2 2025 earnings call in late July, it seems to be a bit of a mixed bag for American Airlines. They beat analyst estimates, but then the stock tumbled. What happened there? That disconnect seems odd.
It's a classic case of what traders sometimes call selling on the news, where a good past result gets overshadowed by a cautious future outlook.
Oh.
American Airlines did report strong second quarter results. They beat both earnings and revenue estimates, and this initially led to market enthusiasm. The stock popped a bit.
But then?
However, the nuance is key, and it's something you, the listener, need to pay close attention to. Our source, the AAL Q2 Deep Dive, specifically highlighted that domestic weakness offsets premium and international strength.
Okay, so weakness at home.
Exactly. While they saw robust demand in international travel and for their higher margin premium offerings, think business class, first class softening domestic travel was a counteracting force. That signals a potential slowdown in their largest market segment.
And then, crucially, they scaled back their 2025 profit outlook and forecast that loss in Q3 we mentioned earlier. This cautious outlook is precisely what caused the stock to tumble despite the Q2 beat. And the CFO declared that the worst is over, which again stands in tension with that Q3 loss forecast. How do we make sense of these conflicting messages? It's confusing for investors.
It absolutely creates a significant tension for investors. It's a puzzle you have to try and solve. The CFO's statement that the worst is over might refer to the broader post-pandemic recovery trend for the industry as a whole, or perhaps more fundamental improvements in American Airlines' underlying cost structure and network optimization efforts. It's a strategic, long-term confidence booster kind of statement.
Okay, big picture optimism.
Right. But the specific Q3 loss forecast suggests that there are still significant near-term headwinds. These could be seasonal factors, maybe a dip in business travel after the summer peak, or specific operational challenges tied to their network.
Like the weather delays.
Exactly. We heard the CEO mention that weather delays had hit American Airlines hardest among its peers. That can have a significant, albeit maybe temporary, impact on costs and revenue. Or it could just be the timing of certain operational expenses, like major aircraft maintenance cycles falling disproportionately into that particular quarter.
Right.
It indicates that while the long-term trend may be improving, the path to sustained profitability is just not linear. It will have bumps, requires careful management of these quarterly fluctuations. This complexity is crucial for you to consider because it shows how challenging it is to predict consistent airline performance in such a dynamic environment.
So a bit of a tightrope walk between optimism and near-term caution.
Yeah.
What was CEO Robert Isom's broader perspective on these challenges and opportunities during the call?
Yeah, CEO Robert Isom elaborated on these points. He openly acknowledged the softened domestic travel demand. He explicitly noted that weather delays had hit American Airlines hardest among its peers, impacting their operational efficiency and punctuality.
But he was still optimistic.
Despite these challenges, yes, he expressed confidence. He expected supply and demand trends to move in their favor in Q3 and Q4, signaling a belief in a stronger recovery as the year progresses.
And he said something about AI.
Yes, he made a notable point about innovation and ethics. explicitly stated that American Airlines won't use AI to bait and switch ticket shoppers.
Interesting.
It highlights a stance on transparent pricing and ethical use of technology, which is interesting given the airline industry's historical reputation for complex and sometimes opaque fare structures. It shows an awareness of consumer trust in an age of advanced technology.
And there was also news about a partnership renewal, right? Something that affects their customer loyalty programs.
Yes, the renewal of their partnership with MasterCard for more rewarding travel experiences was announced around the same time. This indicates an ongoing strategic alliance that's crucial for American Airlines loyalty programs like Advantage.
Those programs make money, right?
They generate significant ancillary revenue and foster customer loyalty. These partnerships are vital for enhancing the customer journey and retaining high-value travelers, especially in such a competitive market.
It's also interesting to see how interconnected the airline industry is. My sources note that earlier in July, Delta's strong Q2 report and bullish outlook actually lifted the fortunes for the entire U.S. airline sector, including American, United, and Southwest. One company's news helps everyone.
That's a perfect example of how the performance of one major player can influence the whole industry. When a bellwether like Delta, often seen as a leading indicator due to its strong operational performance and business travel focus, reports strong results and projects optimism, it often signals broader positive trends for the sector.
Like what?
Could include stabilizing demand, favorable cost environments, or just a general improvement in the travel landscape. Such news can translate into a temporary boost for competitors, even if their individual results have specific nuances or challenges. It's like that saying, a rising tide lifts all boats in the sector.
Right.
It shows the strong herd mentality and interconnectedness of the market sometimes.
So they're navigating these complex market forces. But beyond just reacting to market conditions, American Airlines isn't just sitting still. They're actively investing in innovation. Their extensive portfolio of U.S. patents highlights a significant focus on leveraging technology across their business. This was surprising to me.
Indeed. The sheer number and variety of patents American Airlines holds demonstrate a substantial and proactive investment in technology and operational improvements across their whole business. This isn't just about flying planes anymore.
Right.
It's about optimizing every conceivable aspect of their operations, from the moment you book a ticket to when your baggage arrives. This strategic focus on intellectual property indicates a long-term vision to improve efficiency, customer experience, and ultimately, profitability.
Can you give us some specific examples of where they're focusing these innovation efforts and what's the strategic intent behind them? What are they trying to achieve?
Certainly. One major and critical area is demand forecasting. This is huge for airlines.
Right.
They hold patents for sophisticated systems like a deep learning-based demand forecasting system, also determining an unobscured demand for a fare class, and demand forecasting systems and methods utilizing prime class remapping.
What's the goal there? Sell more tickets.
The strategic intent is clear. By using advanced analytics and AI, they aim to predict passenger demand more accurately. This is absolutely critical for optimizing pricing, making sure every seat is sold at the highest possible price, maximizing revenue, and efficiently allocating capacity across their vast network.
Right. Fewer empty seats.
Exactly. In an industry with those tight margins, precise demand forecasting can be a massive competitive advantage. Minimizing empty seats and maximizing yields, that's the name of the game.
That's incredibly important for profitability, directly impacting their top line. What about operational efficiency? Getting planes and people where they need to be on time, safely. That must be a logistical nightmare for any airline.
It truly is a colossal challenge, and their patents reveal a strong, concerted focus on streamlining ground operations, maintenance, and crew management.
How so?
For example, they have patents for systems and methods for social network assistance, maybe for internal communications or customer support. Also, monitoring and detecting errors by location and common dependency within a complex digital ecosystem, which sounds like improving IT reliability. They're also patenting systems like suggested gate pushback time, mobile ground equipment location monitoring, and multiple patents for a monitoring alert system for airline gate activities.
So trying to reduce delays on the ground.
Clearly indicates efforts to reduce delays, cut costs associated with ground operations, and improve the reliability and efficiency of their entire system. Further, they have patents for predicting maintenance events using machine learning.
Ah, predictive maintenance.
Right. Also, airline flight operations support, restricting airplane pushback based on gate hold times, and even an employee scheduling system providing transparency.
What's the aim of all that?
The strategic aim here is to minimize operational disruptions, reduce maintenance costs through predictive analytics, and optimize crew utilization, all critical for improving punctuality and, ultimately, the bottom line.
So they're really optimizing the back end, which for an airline is arguably as important as the front-end experience. But what about the customer-facing side? How are they innovating to enhance the passenger experience directly? What patents do they have there?
That's another significant area of investment, yeah. Aiming to make the travel journey more seamless and pleasant, they have patents related to enhancing the customer journey from check-in all the way to in-flight services. Examples include a context-based communication platform indicating efforts to provide more personalized and timely updates to travelers. There's a virtual measurement system for baggage management, likely aimed at reducing baggage issues and improving efficiency. And notably, a virtual automated real-time assistant suggesting advanced AI-driven customer service.
Interesting. What else?
There are also patenting systems for streamlined access to secured areas, like granting access to a secured area via a door and based on a travel document, and mobile check-in and user verification for access to secured areas such as lounges.
Okay, speeding up the airport process.
Seems like it. Plus, there's a focus on providing relevant and timely information associated with the travel itinerary, ensuring passengers have all the necessary details at their fingertips, and even systems and methods for payment processing during vehicular travel, which potentially hints at integrated ground transportation payment solutions. All these demonstrate a clear push towards a more seamless, tech-enabled, and user-friendly travel experience, trying to differentiate American Airlines in a highly competitive market.
And it looks like they're even patenting things related to their physical assets and logistics beyond just the planes themselves, covering every facet of their vast operation.
Correct. They've secured patents for things like a specialized printer system, sounds mundane, but vital for baggage tags and boarding passes, showing attention to even small operational details. Also, a portable cylinder assembly torque tool and a thrust reverser cowl rack, specialized tools for aircraft maintenance, and a cargo management system and methods.
So down to the nuts and bolts.
These highlight how American Airlines is innovating even at the granular level to improve their physical infrastructure, logistical operations, and maintenance procedures, all directly contributing to efficiency, safety, and reduced costs.
So what's the big takeaway from this extensive and incredibly varied patent portfolio? What does it truly mean for American Airlines' long-term strategy?
The implications are pretty clear, I think. American Airlines is not just passively recovering from past challenges, it is actively and proactively leveraging technology across its entire value chain.
Right.
This robust patent portfolio demonstrates a strategic commitment to improving efficiency, reducing costs, and significantly enhancing the customer experience. This proactive approach is critical for maintaining a competitive edge in what is, as we've said, an incredibly challenging and complex industry with those notoriously thin margins.
So it's about long-term survival and maybe growth.
It shows a deep commitment to long-term operational excellence. That can be a fundamental differentiator and a key driver of future financial stability and growth in a sector that demands constant innovation.
Beyond innovation, American Airlines also has a significant presence in Washington, D.C. Let's talk about their corporate influence through lobbying. What does the data tell us about their engagement with policymakers? Are they spending a lot?
They demonstrate a consistent and substantial investment in corporate lobbying, yeah. Our sources show they've consistently spent over $1 million per quarter since 2009.
Wow, consistently over $1 million a quarter.
Yes. Recent figures are hovering around $1.1 million to $1.2 million per quarter. For example, $1.21 million reported on July 21st, 2025. This pattern of sustained, significant spending demonstrates a long-standing and active effort to influence policy and regulations that directly affect their business and the broader airline industry.
It's clearly important to them.
It's a clear signal that they view engagement with government as a critical part of their strategic operations.
And they lobby on an incredibly wide range of issues, not just those directly about aviation, right? It seems like they engage across the entire spectrum of policy that could touch their operations.
That's absolutely correct. While Aviation Airlines Airports is consistently at the top of their lobbying efforts, showing their core interests, their lobbying spectrum is remarkably broad. It covers nearly every angle that could impact their financial health and operational environment.
Like what? Beyond aviation?
Includes crucial financial and economic areas like financial institutions, investment securities, taxation, internal revenue code, and budget appropriations. all vital for managing their capital structure and profitability.
Oh.
They also engage heavily on regulatory and safety issues such as homeland security, consumer issue safety products, labor issues, antitrust workplace.
Labor issues make sense.
And even environmental concerns like Environment Superfund and clean air and water quality. Given the industry's environmental impact, influencing policy here is increasingly critical.
Right.
We even see lobbying on social and workforce issues like immigration and retirement, which directly affect their large workforce and operational flexibility. This comprehensive approach reflects their deep interest in shaping the entire regulatory and economic environment in which they operate, ensuring a favorable landscape for their business.
And this isn't new for them?
No. The lobbying data goes back to 1999. It illustrates just how long-standing and active their role has been in Washington.
And just to clarify, while they lobby heavily, my sources explicitly state that there are no government contracts for American Airlines. So their influence is more about policy shaping and the regulatory environment than direct government business or revenue.
Exactly. That's an important distinction to highlight for you, the listener. Their engagement with the government is primarily focused on influencing legislation and regulatory frameworks that impact the airline industry as a whole, rather than securing direct revenue streams from federal contracts. This completes our objective picture of their diverse activities beyond just flying planes, showing their proactive stance in shaping the environment they operate within.